The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Is the worst finally over for this market, or, well, is it simply the eye of the storm? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Welcome back, by the way.
Thank you. I'm so glad to be back at work.
I can imagine he's just so brimming with happiness. All right, let's get a check here on the markets. It is definitely a relief rally underway. The S&P up 1.6%, right around the highs of the session, despite the fact that President Trump said that automaker tariffs are coming sometime soon. Lumber and cars and chips maybe as well. Equity markets taking it in stride, a bit into the NASDAQ. You have a sell-off in the Treasury market. Look at that back end there, up by about 8 basis points. And gold also selling off. Classic risk on trade, Romaine.
I don't want to jinx it, Alex, but it does look like, at least in the equity market, maybe there is some actually conviction to this rally. 57.18, that was the market open on the S&P. That was also the low of the day, and that does suggest a degree of conviction here, which is setting us up for what is actually going to be the first back-to-back daily gain for the S&P since mid-February. That optimism, of course, rooted in the bet that the Trump tariffs may end up being more precise and less of that scattershot that had rattled investors for the past few weeks. Even Morgan Stanley's Mike Wilson is feeling more optimistic, seeing scope for a, quote, tradable rally as oversold momentum, stronger seasonal performance, and quarter-end flows support a rebound. The optimism, though, dependent on follow-through from the White House on being more precise. So until we see a more deliberate approach on that policy, Wilson and other Wall Street strategists are still urging folks stick to high-quality stocks as a natural hedge against volatility and economic risk. That economic risk front and center with a report on consumer confidence tomorrow morning that economists expect will reflect anything but confidence. A PCE report on Friday that will likely show core price inflation rising at double the pace consistent with the Fed's 2% target. And then, of course, there was that report this morning that showed U.S. manufacturing slipping back into contraction while sentiment among services providers deteriorating once again. Alex, what's going on?
It's that soft data, right? Just does not look good, which raises the question, are we eventually going to be in a stagflation scenario? So growth kind of middles along, and then you wind up having inflation moving higher. So Bank of America had this great chart out that took a look back to stagflationary periods to check out what actually did really well. And they said quality and cash return momentum did really well, right around 5%. Where you don't want to be is risk, growth, and value. So if we are going into a stagflationary environment, where are those quality opportunities? On the flip side, Julian Emanuel of Evercore ISI said, look, we've hit or we're near peak uncertainty, and you could also see now recovery in stocks as that pessimism has really come out. And Romaine, it feels kind of binary from that direction.
Yeah, absolutely. Well, let's get some answers maybe out of our first guest. Meera Pandit joins us. Global market strategist at JPMorgan Asset Management. Great to see you. It's been a while.
It has.
I think the last time, at least we've spoken to you in the show, was kind of before some of the market ructions that we've had. We had that correction, which I guess now is a thing in the past. When you look at the price action today, and even kind of what we saw towards the tail end of last week, does that give you a little confidence that maybe the worst is behind us?
It's certainly good to see that volatility has come down, the VIX is back below 20, and markets are somewhat stabilizing here, but we haven't quite seen that recovery in the overall market yet. I do think we need to see a couple of things in order to have a more durable, sustainable recovery in markets and a more degree of stabilization. One would be that valuations are still about 22% more expensive than their long-time averages, so seeing a little bit more of a re-rating there. Earnings expectations are still about 270 on the S&P 500. We'd like to see that be a little bit more realistic, in line with how companies individually are guiding for the future. If we think about once we actually see earnings come down a bit, that's going to artificially then push valuations up, so you have to see a bit of a feedback loop there. 3 would be to continue to see some pretty solid economic data. Jobs, CPI, retail sales have looked good. More recently, industrial production and some of the housing data around existing home sales, housing starts, have showed that maybe some of the January slump was weather related. And then if we think about tariffs, the talk of the town today is seeing somewhat of a consolidated strategy around tariffs. It's not that they necessarily need to go away, because we don't think that they will. But if there's at least some degree of markets being able to price in and out things that are and aren't subject or in scope, that's helpful.
Is the political risk, the policy risk, I should say, I know it's not gone, but has it been minimized to a little bit, or is it still elevated to the point that investors should at least be cautious?
It's still elevated. Investors should still be cautious. It's hard to say what the next step is here. While there's a lot of optimism around April 2nd and seeing, again, that consolidation of the tariff narrative, we don't know if that's it. It certainly probably isn't. And there could be some upside risk to policy here. There are certainly things like deregulation and the M&A and IPOs that might bring along with it, or tax cuts that could start to provide some upside policy risk here. But overall, we're still in wait and see. I think the good news in terms of markets is that equity markets are starting to catch up to where yields landed, because yields went on quite a big slump for a while there and have somewhat stabilized, and the equity market is now, I think, catching up.
So does that mean quality? Does that mean value? Does it mean growth? Where in the equity market?
It means that if you're getting back into the equity market, we still don't want to just jump into the index level, because while the Mag 7 are down about 12% year to date, the concentration issue is still there. So while some of that has been passively allayed to some extent, it's still mostly there. We want to think about being a lot more selective. And actually, outside of tech, consumer discretionary, the rest of the sectors within the S&P 500 have moved higher. You've also seen that if you look at stocks and their 200-day moving averages, about 40% of stocks are above that. A year ago, that was 80. So clearly, this is not a momentum rally anymore, but certainly there are still pockets of the market that are doing well.
There is a narrative out there that you want to move away from, say, U.S. exceptionalism towards countries that are actually fiscally expanding, like a China, like Europe. Do you guys over at JPMorgan feel the same way?
A bit of a mix. I would say areas like China, you've already seen the rally start to fade a little bit. And as much stimulus as they might want to do, I think there's somewhat of a cap in terms of wanting to continue to foster quality growth and deleverage, right-size the property sector in a sensible way. We have seen this story before with China, a couple of different 20% rallies over the years, and usually they do fade. Europe is a different story where you're seeing that optimism there. And if you look at the composition of the rally so far in China and Europe, what I think is most interesting about the European rally is not just the multiples component, which you're seeing consistently across the board, but the currency component. Because to me, that points to the fact that while from a rates perspective, Europe is probably headed to 2%, the US might be headed to 4% right now. But from a growth perspective, that US exceptionalism story is cooling off a little bit as growth moderates, but there's actually potentially some acceleration in growth in Europe. And that's how currency has become such a big factor there, too.
I'm also curious, too, about that European trade, because some of that was also based on this idea of just structural changes, the idea that they would have to increase, Europe as a whole would have to increase defense spending, as well as other types of spending that normally, I guess, would have drawn or sort of would have pushed more towards the U.S. side. And that's why you're seeing some folks there. That hasn't really changed, though, right? I mean, even, if he backs off on tariffs and backs off on this, Europe's not somehow going to do an about-face and say, OK, we're going to re-embrace America again, or are they?
Well, I think that they could play the best of both worlds, really. To not have trade as a headwind anymore would be great, but also to continue to move towards greater self-reliance, because I still think this is an aha moment, not only in terms of defense, but also when we think about bureaucracy wanting to be innovative and self-reliant on their own. Some of these knock-on impacts, I think, is gradually tweaking the psychology within Europe, and those provide some pretty powerful catalysts to start to get earnings to contribute a bit more to the rally, and some of the earnings revisions have been positive.
So how do you then, if you're looking at the totality of your portfolio, I mean, how do you diversify? Because some of that diversification over the last few weeks was geographic, right? European stocks versus U.S. stocks. Some of it was also had to do with, momentum and growth and other growth factors. Is there sort of a reliable diversification strategy now, or is everything unreliable?
The unloved areas have done remarkably well this year. When we think about Europe, when we think about value, positive over growth, which is still negative. Again, Europe double-digit returns relative to the U.S. down. Duration has been an area that has really helped portfolios as well. So it's essentially everything that people thought coming into the year would continue to be unloved and that have been reluctantly held in portfolios for the sake of sensible diversification is actually winning. Because so many times over the last couple of years, when we've looked for something more defensive, it's actually been tech. And that hasn't been the case so far this year. So the diversification is working. working.
All right, cool stuff. Meera, great to see you again. Always great insights. Meera Pandit, Executive Director and Global Market Strategist over at JPMorgan Asset Management, kicking us off to the close on this Monday afternoon. A big focus on tariffs and the consumers that are spending wisely as the world remains on that tariff watch. A catch up just in a little bit with Michelle Meyer, Chief Economist at Mastercard.
Looking forward to that. Plus, Guggenheim analysts like what they see and they're pinning it up on their boards. Pinterest shares up today after an upgrade. We're going to talk to the analysts behind that call.
And we're building up to KB Home results coming out after the bell tonight, hammering out the details of those second quarter results. We'll do that just a little bit later. All that and more coming up in just a bit, right here on The Close on Bloomberg.
BYD sales surpassing the $100 billion mark in 2024, beating estimates, breezing past Elon Musk's Tesla when it comes to revenue. BYD has a range of EVs and hybrid cars packed with high-tech features and now 5-minute EV charging. Joining us to discuss for more is Bloomberg's David Welch. David, why is BYD doing so well right now?
Look, they've got good products. They've got them at competitive prices. And all of the EV companies in China are really surging, but BYD's really been the leader in getting more sales in the EV segment there. Their plug-in hybrids are really good for certain buyers in certain markets, including China. And they've got some cool technological features. So you give them an open road like they have in China to grow, with the foreign automakers, GM, Volkswagen really struggling there. A lot of that's because of things the government is doing, but a lot of it is because the domestic cars are also very good. And it's a recipe for growth there. And they've done a very good job exporting as well. They're growing in Europe, they're growing in South America, and they're selling vehicles in Mexico now too. So they're on our doorstep. And there's really, there isn't a major market other than the U.S. and Canada where they're not really making a big push at the moment.
Yeah, it'll be interesting to see if they can crack the U.S. market. I am curious, David, though, about how much this company has grown. Are they basically broadening the market for EVs, or are they actually taking share away from Tesla itself?
It's a little bit of both. I mean, they are getting buyers from Tesla, but you look at the Chinese market, and there are a lot of incentives and a lot of rules against straight-up internal combustion vehicles that make EVs the thing to buy. But they do have good technology. They've got low cost, so they can sell their vehicles and make money on them at lower prices than a lot of companies can. They've just got a supply chain for battery minerals and ingredients that just make it easier for them to sell these vehicles without having to charge a big premium like you see here in the United States. So they're getting some new converts, some new buyers, and they know their own market very well.
We can't buy those cars here in the U.S. Do you think at some point we will? And I realize that question's a little silly considering the auto tariffs maybe coming down the pipeline, but nonetheless.
Look, eventually I think we could, but there are some barriers to that aren't just the tariffs. And the tariffs are real. That's one of the reasons they're not coming here. The other is they haven't had to come to the U.S. because they have so much growth going on in other markets. But it's very difficult for BYD to sell a vehicle that would meet U.S. safety standards for the prices that they sell them in other markets. So their vehicles would be more expensive if they sell them here. For example, I know someone personally who bought a BYD vehicle. It's about the size of a Chevy Bolt, and it sold for, I think he paid $29,000 for it, and it gets less range than the Chevy Bolt did before the GM took it off the market. So the stuff that they're going to be selling in this part of the world is not going to be super cheap like it is in China, but it's going to be very competitive if and when they do get here. But they would have to make the vehicles here, they would have to meet U.S. safety standards, and that's a whole different calculus than just exporting a vehicle here from the current park of cars that they're selling in China.
Yeah, particularly given the change in political climate over the last few months. David Welch, your man out there in Detroit, the headline of the day, BYD, the Chinese EV maker, now topping Tesla in terms of actual sales on a dollar basis and also matching them on a unit basis as well. And Alex, I was just on vacation in case you didn't hear.
You weren't here last week?
Yeah, I
Weird.
know. I know you missed me. I was driving around the country as I do, talking to real people. We actually rented an EV.
Oh, you did?
I'm not going to say what brand or make because I don't want to get myself in trouble here. I was a little disappointed in the experience.
Oh, yeah?
We went through this whole process of thinking we were going to buy an EV last year, and we ended up getting a hybrid.
Yep.
And we actually drove one of the EVs that we wanted to buy. The range was concerning.
So meaning that like it just drained really fast, and that's what was upsetting about it?
And it drains even faster if you're like at 50%, it drains faster if you're 100%. So there was all this, and then it was always, we have to find we're an EV thing. And keep in mind, for our viewers, we were in California, so there were plenty of EV states, but they were still spread out pretty far, and you really had to do a lot of math and calculus and making sure that you were going to be at the right place at the right time, whether the charger was going to be a fast charger. When we plugged it into one charger, and it was like, it'll be 100% charged at 2 a.m. Which is like about
7 hours later.
9 hours later, right? And it's like, okay, well.
Which is interesting because it was California, which is the area where they have a lot of stringent rules in order to sort of reignite EV adoption. So you'd think that the charging stations would be a little bit different. Do you feel like, does the hybrid work for you?
Yeah, it does.
Okay, so you like the hybrid?
Yeah, you fill it up a couple times a month.
And you feel good about that?
Yeah, I do, sure.
Okay.
All right.
Good
Thank
chat.
you. This is a nice conversation.
I'm glad we had this conversation.
And I'm back, Alex.
Here.
All right, we're going to take a look here at what's been going on with Pinterest. Those shares actually popping today after an analyst over at Guggenheim boosted their rating. That's coming up next in our top calls. This is Bloomberg. All right, let's get to our top calls. Big movers on the back of analyst recommendations, and we start out today with Boeing. An upgrade to buy over at Melius Research is coming just a few days after the plane maker beat out Lockheed Martin for a contract to make the next generation U.S. stealth fighter jet. The analyst also boosted his price target to 204 from 189 and lauds the company's new operationally focused CEO, as well as a faster than expected 737 delivery ramp. Those shares up for a fourth straight day, up 1.8%. Next in line, Lennar, Evercore ISI cutting its rating to in line from outperform, slashing the price target to 131. The firm says the home builder's strategy to maintain and promote volume, well, that's going to keep profitability at, quote, dramatically depressed levels. Nevertheless, the shares enjoying a little bit of a boost today, up about 1%. And lastly, Pinterest. Take a look at this. Guggenheim hitting like on the social media company with an upgrade to buy. The analyst says user growth trends remain healthy, and he expects monetization of that user base to grow at above market rates. Those shares up 5%, and those are some of our top calls. And we do want to stay on that last call on Pinterest. Look at that, $33.99 right now. Michael Morris joins us, Senior Managing Director over at Guggenheim Securities. And Michael, first let's talk about this idea of monetization, because we've talked a lot about Pinterest user base and the growth there. But they also seem to be much earlier in the process compared to their social media peers of really extracting revenue from that user base. How's that going?
Well, I think it's going very well for them, and I think they're really well positioned to see some continued momentum throughout the year. As you mentioned in the lead-in, we believe they will grow faster than the industry average. They will be an above average grower. And remember, this digital advertising industry is a high growth space in and of itself. So we're looking for some healthy teens growth both this year and into 2026. And we think that's a function of them taking this great platform that they built, really nurtured and drove a lot of usage and a lot of engagement within the user base. And now they're really turning on a successful monetization engine that we're attracted to. We think we have a good opportunity to buy it at a great valuation here.
I mean, what's kind of the secret sauce in that? Because when we talk about monetization, we're basically saying, like, look, we put something in front of you. In theory, there's going to be some follow through. You're going to click on the link, or you're somehow going to follow through with some type of a purchase or other types of engagement. Is there something unique that they're doing that the others aren't?
Well, I think the real uniqueness of Pinterest, first and foremost, is that people go to Pinterest with purchase intent. So that's the thing to keep in mind. For most social media platforms, the monetization in the form of advertisements is an interruption to the experience, right? In the case of Pinterest, the advertisements actually enhance the experience for most of the visitors. And that's why you see a situation with Pinterest where I mentioned they've grown their users. They've grown their engagement and the frequency of visitation and the length of visitation, and they've even grown the impressions that they serve. So they're able to provide more advertisements even while seeing more engagement, right? So you're not degrading the experience, you're actually lifting the experience through monetization, which is very unique to Pinterest amongst social media peers.
Which is such a great point. Like, you're going there at the express point of looking to buy something. So the spend that they've done on AI, it's obviously done really well in terms of attracting user engagement. Is that AI spend, though, like capped out, and they can just can kind of recoup and go from here?
Yes, so it's a little bit of both. When we look into the coming year, I think you will see them invest and actually invest at an even higher level with respect to their tech investment growth in 2025 versus 24, but not faster than the top line. So you will still see profitability growth and margin expansion for the company, albeit at a little bit of a lower rate, which we don't have a problem with because what they are investing in has already proven to be successful. So we see the company investing in these AI-enabled processes that include everything from helping their advertising partners with their creatives. And that's great when you want to get into medium and small sized businesses and help them when you can provide that creative service for them. But it's also about getting the right advertisement in front of the right person at the right time, and then measuring the performance of that advertisement so advertisers themselves can feel comfortable with putting more money to work. So really several fronts that they're showing success on with the use of that technology that they will lean more into in the coming year, even while growing their profitability.
So, Michael, that is the Pinterest specific upside. What about the macro economy and consumer? Like, what's the relationship between consumer spending and Pinterest, because that could be a risk?
Absolutely. It is the largest risk in the near term, in my opinion. So I'm not making a macroeconomic call here per se. We do a lot of work on the advertising market health in general. We speak to advertisers, we speak to the companies, and there's certainly a little bit of shakiness in the market right now. I think less so on performance-based advertising, those types of advertisements you see on digital platforms that have things like click to go to a new site or perhaps make a purchase. That advertising has held in better than the so-called brand advertising, which tend to just drive awareness. That said, I think it's very difficult to say there will not be any more incremental pressure at these advertising platforms, okay? However, I think that expectations for Pinterest as I look into the second quarter and the balance of the year are conservative at this point. So we do like the setup from a tactical perspective. And also, I believe that the advertising market in general over the longer term will be healthy and very durable. And this is not just a cyclical story here. This is a secular story that Pinterest is able to seize on and be a beneficiary of. And that's why we're using this sort of pullback on the economic concern and the advertising concern as an opportunity to get long the shares.
All right, Michael, thanks a lot. Really appreciate it. Michael Morris, CFA and Senior Managing Director at Guggenheim Securities. My daughter's birthday cake and decorating a house. Those are the two things Pinterest love, my jam.
Yeah.
But that's not consistent. But
yeah, I know a lot of people use it to plan parties and weddings and things like that. So maybe my next party I can
was like,
try to
your next wedding? Like, what are you saying?
No, gosh, no. It's a bit.
But do you really plan your own parties?
Yes, I do. As you know, I'm pretty controlling, Alex Steele. But yeah, I've already thought ahead to my. And isn't your birthday coming up?
No,
it is.
It is actually, absolutely not coming up.
You know what? Egg party for Alex.
Egg party?
Wheel out the melon cart.
What's an egg party?
You're going to find out.
Okay, great. All right, coming up, you got consumers watching their spending. You got new tariffs set to be announced on April 2nd. We're going to speak to Michelle Meyer, chief economist over at Mastercard, to get an idea of what they're spending on, what they're holding back on, and how much they're putting on their credit cards. This is The Close on Bloomberg. Happy Monday, everybody.
.30 p.m. here in a rainy New York City. This is the countdown to the close. I'm Romaine Boston.
I'm Alex Steele. Aren't you glad you came back to New York with
I
this
love it.
lovely weather? So
incredible.
Great. So clearly we're around the highs of the session, which is extra interesting because the PMI data that we got from global S&P earlier was not great. Manufacturing contraction again. Services, the headline number was okay, but if you take a look at expectations in terms of services, it was rolling over.
But should I be worried about that? I mean, because it seems like all the bad stuff are expectations. It's not really the hard data in terms of what's happening in the here and now. So can't those expectations change?
Absolutely. Okay. So does it get deferred and all of a sudden it doesn't transfer into the hard data, or does that soft and then negative soft data actually translate into no buying? Well, good for us that we're not going to answer that question, but Michelle Meyer will, chief economist over at Mastercard Economics Institute. The negative data that we've seen, do you expect that to become part of the hard data in terms of consumer spending?
I think, as Romain said really, really well, which is we just really don't know, right? Most of what we're seeing now is the expectation starting to roll over in the survey data. And for good reason. There's a ton of uncertainty right now. And a lot of that uncertainty is coming from potential policy changes, trade, top of mind, tariffs. We're going to learn a lot more potentially on April 2nd. But until there's clarity, I think expectations are going to remain a bit low because of that discomfort about what's to come.
So do you get the impression that consumers are delaying purchases, or are they going into heavy purchases now just to avoid tariffs, or are they just going to put them off altogether?
Look, I think there's a lot of cross currents right now for the consumer. So when you first take a step back and you think about, okay, what are the fundamentals for the consumer? Have they changed since the end of last year? And I think largely the answer is no. Job creation is still running at roughly the same rate. There's been a sell-off to some extent in the stock market, but when you think about the wealth effect, that happens, it's cumulative, and it happens with a lag as consumers respond to it. So maybe there's a little bit shift to wealth effects, but most of the research would suggest that takes a long time for that to roll out into the data. So for the most part, the fundamentals are roughly the same. The big factor that has changed is the unknown on the horizon, that uncertainty, right? And potentially some of the tariffs already kicked in are starting to show up in terms of price increases on the margin. I don't think in a big way yet. You can certainly see that from the CPI data. So I think it's really about what's on the other side that's making consumers a little bit uncomfortable, but you're not seeing a big shift in terms of the trends.
Well, and I am curious, though, too, when we talk about expectations, if expectations are sour and we say that affects spending in the here and now, like what gets deferred? Is it like, okay, I'm not going to buy a new washing machine, or is it something like I'm not going to take a vacation?
Well, I think if you're looking to buy a new washing machine, you probably want to do that soon, right? Like I think that is the tariff story where people may actually look to pull forward some of that spending. And we did see that to some extent when we look at this card spending data. We pulled out durable goods like appliances, and there was an acceleration at the end of last year and into early January. So potentially that was consumers trying to get ahead of the tariffs. Hard to know the drivers for that. But I think when you look at the breakdown of spending, so here's another good example, right? When you think about food spending, that's a choice that consumers make. Do they go to the grocery store and eat at home, or do they decide to go out to restaurants? When we look at grocery store spending, it's been trend-like. It's been very stable. When we look at restaurant spending, you saw lots of strength right around the holiday season. Prior to that, a trend of about 5% or so year-over-year growth. It certainly softened in February, kind of flatlined a bit. More recently, it's looking like it's returning to trend. Is that uncertainty? Is that weather? Is that the typical February lull? Is that the timing of tax refunds? There's so many dynamics that are out there that I think it makes it really hard to dissect what's actually happening.
Are you seeing any meaningful difference let's assume people are still spending, are you seeing any meaningful difference in whether they're paying with cash or they're willing to buy things on credit or other types of debt?
Well, I think for that, looking at the Federal Reserve's G19 data, monthly consumer credit installment data, or the New York Fed's quarterly household survey, both of those are good. And again, very trend-like. You're not seeing things break or shift in a meaningful way that would indicate consumer dynamics are changing. The only thing that's breaking and shifting is survey data suggesting that consumers are worried about what's to come.
Have you ever seen something that divergent before?
Oh, for sure. We've seen periods where survey data says one thing and real data said another. In fact, this most recent episode with COVID creating uncertainty, policy changes, again, being a little bit up in the air following that, and big inflation swings left consumer sentiment surveys, particularly the University of Michigan sentiment survey, to suggest a pretty tepid environment for the consumer for a while, yet all the hard data, all the real spending was still coming in very strong. So we constantly had conversations in the last few years about, well, why is sentiment saying one thing and actual spending saying another? And in that situation, it was because consumers were facing unwanted price increases that were making them uncomfortable, but they had the ability to still spend.
Right, they didn't like it, but they could still afford it.
But they did it, yeah.
So my takeaway from what you're saying is that things are fine. There are worries, but there are no actual cracks in anything that you've actually seen yet.
To me, it's going to be very much a function of the labor market. At the end of the day, for consumers, it's the health of the labor market. It's whether or not consumers are employed today. how they're seeing their wage growth evolve, and whether or not they think they'll be employed tomorrow. And when you look at initial jobless claims, they're staying at low levels, absent, of course, some of the layoffs announced in the federal workforce. And we'll see what the next jobs report reveals. But certainly last month showed pretty trend-like job creation.
It's kind of interesting, too. I mean, we get some more survey data this week. We talked about the conference board, and I think you missed at the end of the week. We also, though, get some interesting hard data, particularly, obviously, the PCE data that the Fed pays a lot of attention to. That's still deteriorating or rising or whatever the phrase is. Basically, inflation's still here.
Yes.
Or at least above target of where the Fed wants it to be. Are they more concerned about that right now? Or, as you just pointed out, the labor market? Can they look to the labor market as a salve and say, look, as long as we're not seeing any massive job losses, maybe we can bear a minor uptick in that inflation rate?
Yeah, so there's a few things that I'd offer on that front. First, absolutely, I think the PCE report is going to be important, not just for inflation, but also to understand personal income trends and savings rates. So very keen to see what that data shows. We have the retail sales numbers. We have card spending numbers like we track. But absolutely, that complete picture is going to be important to see income, spending, and savings. And then to your point around the Federal Reserve and how they navigate inflation versus jobs, of course they have a dual mandate. To me, when you listen to Chair Powell in the most recent meeting, he was emphasizing the labor market quite a lot, especially if you have temporary shocks to inflation because of tariffs. They're going to have a hard time being able to determine price level shocks versus something that's more sticky when it comes to inflation.
Just real quick, we only have about a minute left, but you mentioned savings. If that number is going up, is that considered a bad? I know economists kind of look at that as being bad for the economy because obviously it's not money in theory going into the economy.
It depends by how much. If you have a shock up in the savings rate, then it would suggest precautionary savings could be happening. But when you look at how things are trending for aggregate wages based off the last jobs report, which is a very good indication of what personal income will look like, it doesn't seem like it's going to be a break.
All right, Michelle, always a pleasure. Michelle Meyer, chief economist over at the Mastercard Economics Institute. A lot of data on tap this week, including consumer confidence data, PCE, as well as home sales. When we come back after the break, a closer look at the market as we get closer to the closing bells, and a closer look at the shares of the decking company AZEK, rising on news that the Australian-based James Hardie Industries is going to acquire the company. We'll talk about that next in our Stock of the Hour. This is Bloomberg. AZEK, that's the name of the company, and it is the biggest mover in the Russell 1000 this afternoon, up 17%. This after reports that the Australian company James Hardie Industry agreed to acquire the company for almost $9 billion US, and some of those investors in James Hardie aren't happy with the news. Those shares, which are based over there in Sydney, actually were down 15% in trading over there. Drew Redding joins us right now from Bloomberg Intelligence. Talk a little bit more here about this deal. And I just want to kind of get to the nuts and bolts of it because I was going down the rabbit hole. I wasn't too familiar with James Hardie, but they get the majority of their revenue from the U.S. They're buying a U.S.-based company that in theory is going to sort of create additional exposure to the U.S. But this does seem to be a very deliberate bet on the idea that the home building sector in the U.S. will be supportive of this for a company that basically makes decks, moldings, and other things.
Yeah, it's a great point. After the deal on a pro forma basis, they'll be about 80% exposed to North America. And I think it's a long-term play on the housing market. I think the company acknowledges that in the near term, there are some consumer challenges out there. And I think that's what you're seeing reflected in the shares of James Hardie. I think investors are just a little bit skeptical of the opportunity in the near term. But if you look longer term, I mean, AZEK has one of the best growth platforms in the building product space, not only from a company perspective, but from an industry perspective. If you think about the composite decking space, it's only about 24% of the total market. The industry as a whole has taken about 100 basis points a share annually. And they think that market could get to about 50% of the total decking market in about 10 to 15 years. So I think it's more of a long-term play on what we call material conversion from wood to composites.
Drew, what do you make of the number? $8.75 billion?
Yeah, a healthy price for the stock, and I think that's what we've heard from a lot of people on the James Hardie side. The announced deal was about a 20 times multiple on 2025 EBITDA for AZEK. So look, I think if you're an AZEK shareholder, you're certainly happy with this. One, because of the full value of the deal, but two, because as we mentioned, despite the strong long-term growth opportunity, when you factor in some of the near-term challenges with the macro situation, I think you're happy with this overall.
So it gets to this idea that assuming this deal goes through and they do this, are we going to see additional M&A activity? I mean, I see all the other home products companies are rallying on the back of this. Is that just kind of wishful thinking?
Well, there has been a couple deals. You had Home Depot last year doing a big deal for a products distributor. You had QXO doing a deal for Beacon Roofing last week. Now you have this one. So I think some people are looking this with the stock price is down over 30% over the last couple of months, maybe as an opportunity to start, building their platform. So when we do get to the other side of this growth slowdown in the housing market, they're in a better position.
Do you think we'll get any more bidders coming in here for AZEK?
I think it's possible that you see some strategic bidders, but I don't know that there's a whole lot of them, just given the hefty price tag and the full multiple. I think you have companies like maybe a Fortune brand or Masco, who might be less interested, and it really has to do with just the price tag of the deal. So, I do think people are interested because of the strength of the AZEK platform, but we'll see. It certainly is possible.
All right, Drew, really appreciate it. Thank you so much. Drew Redding of Bloomberg Intelligence joining us there on that potential deal. So we're still right around the highs of the session. We're up by 1.7%, although options for the next 2 weeks are definitely looking at some implied moves of almost 1% either way in that window. That's according to Citi, because you got jobs and you got tariffs. Yeah, you got a lot of potential volatility up ahead here for the markets. But, I mean, if you're looking for a silver lining, I mean, I do think that if you do a daily chart here, I mean, you are seeing real conviction in buying. This isn't sort of one of those where we get the big pop, that big gap up at the open, and then it just kind of fades through the day. This has kind of been up and stayed up. No, totally. I'm still skeptical, but I'm like gold bars and soup cans under my bed. But we are about 15 minutes away from the closing bell. We're going to break it down with Paul Christopher, Managing Director and Head of Global Market Strategy at Wells Fargo Investment Institute. We'll see if he feels as positive as Romaine here. If you're looking at the S&P, up almost 2%. Happy Monday.
Welcome back to The Close. Just 10 minutes until we get to those closing bells. Romaine Bostick here alongside Alex Steele. The S&P 500 setting up for back-to-back daily gains. But look at this. Just looking at the chart, Alex Steele, going to close above that 200-day moving average. I mean, barring a big breakdown in the next 10 minutes.
I appreciate I was poo-pooing this just a second ago. Yeah. But then I looked. The Mag 7 rallying the most since mid-January. The Russell seeing its best day since November. So the best day this year. Same for the SOX, the semi-index, rallying the most since December. So we are seeing some pretty powerful moves here. But can it last?
Wow. So are you a believer
No,
now?
But can it last is still my question. But I can't deny the superlatives.
Yeah, absolutely. And I mean, look, if you go across the tape, you look at the technicals, it's not just stocks here. You're seeing that drop in the VIX. It's interesting to see the price drop they're going on right now in the Treasury space here, and don't really have much concern right now when it comes to the FX market and commodities not getting in the way, at least for today, of the equity rally. Paul Christopher joins us right now, Managing Director and Head of Global Market Strategy at the Wells Fargo Investment Institute. And Paul, we focus so much on these day-to-day moves in the market. I do want to focus a little bit more long-term for a second, because we've seen these ructions back and forth, and there does appear to be a willingness to come into this market and buy, assuming investors have some confidence or reassurance, at least, that maybe whatever chaos, whatever policy volatility is coming out of Washington, that will be minimal and manageable. Is this that moment?
Yeah, I'd like to say so, but I'm a little bit more on Alex's side with this one, where this anticipation that next week's tariff announcements will be targeted and narrow. That may or may not happen, as we've learned already from the president. He likes to kind of get his negotiating partners thinking one way, and then he takes them another way. So that does seem to be what's driving the markets here, but we'll really have to wait and see until next week.
Well, then what sort of becomes the investment thesis? And I'm talking more the long-term investment thesis here. Do you make a play to, say, domestic companies? Do you make a play into tech? Do you buy just, European defense stocks? What?
Yeah, so our basic view is that the tariffs are negative for the economy, but not negative enough to derail the growth that we expect this year. We don't think there's a recession. You'll see some people on Wall Street have elevated their or raised their recession probabilities, but maybe from 5% to 25%. That's still not 50%. So tariffs can be adjusted to. People adjust to taxes all the time. And we think we're going to see some flexibility and some adjustments, some substitutions that are going to be made for a lot of companies, not all, but for a lot of them. And so that leads us to think, okay, if you're going to have growth, then you're going to have earnings. And if multiples have been compressed here, that means there's room for multiples to rise, especially if inflation slows and rates stay low. So what we think is what we want to do here is maybe avoid some of the volatility in long maturities, long investment grade maturities. Take some of that money out, put it in shorter term maturities, protect some of your capital. Meantime, go to the middle part of the yield curve, 3 to 7 years, pull some of that money out. Let's put it into U.S. equities. We still think the U.S. is the best, and we're already overweight large caps. So we kind of like mid caps here, potentially as ways to deal with tariffs if mid caps become a source of suppliers, or source of supply to some of those larger U.S. industrial firms.
Oh, that's interesting. So would that, for the mid caps, be a play on, say, quality and safety, or a play on a cyclical recovery, or a totally third prong?
It's a play on quality and safety for right now. But if we do get the growth that we're expecting, and we do think growth will accelerate into year end because we're going to have some tax cuts, we think deregulation probably plays more of a role as time goes by than it does at its inception, let's say earlier in the year. So growth figures we think to pick up. And at that point, we think you might even see some cyclical opportunities popping up. And by the way, on the large cap side, we still like cyclicals there too. So we've got that bet already in place. We like industrials, we like financials, we like energy.
What about tech?
On the tech side, we put a marker down on an overweight to communication services a while ago, and we're still waiting for a good price to get in there. But we do see some good prospects for tech going forward. We just didn't feel like paying multiples of 30, 35, 40.
So when we talk about economic conditions overall, Paul, and how that feeds into the economy and ultimately feeds into corporate earnings and then, of course, market prices here, is there a sense that the economic growth story that has sort of provided us with that American exceptionalism or whatever we want to paint it, that is at least still intact long term, despite whatever short term disruptions we may have?
Yes, that's right. Keep in mind that Europe, which has caught people's eye lately, European equities have risen, but they've had very, very cheap multiples. So if you introduce some policy uncertainty to the U.S., where's that money going to go? It's going to go someplace where it thinks the buying is cheap, and that's to Europe. And yes, to be sure, they're going to spend some money on infrastructure in Germany. They're going to spend some money on defense, but that's in the future. And how many countries can really afford that in Europe? And what's their energy situation going to look like beyond this year? When are we going to have Russia resuming gas sales to Europe? I don't think so. So they've got some serious issues longer term still to deal with. There's a reason why those multiples were low in the first place. A lot of regulation, too. We like the U.S. better.
All right. What's kind of the big risk, though, that you are keeping an eye on right now, Paul?
The real risk here is, coming from two sources, both policy related. One is what will happen with tariffs? Are they really going to be winding down here? Are the announcements going to be winding down here? Are they going to get more targeted, or are they going to be more universal? And the second one is what's going to happen in this budget process? We haven't heard a lot about it so far. Yes, we got past the shutdown with a continuing resolution, but how are they going to pay for the tax cuts that the president wants? Is that going to mean a lot less spending or some taxes elsewhere going up? And that could be contractionary, more contractionary in government spending than what we had anticipated. That would be a little bit more of a headwind.
Before we let you go, I know you talked about mid caps, but the Russell is seeing a pretty powerful move today. At one point, the biggest rally since November 6th. We're at that high, but nonetheless, when would you like small caps?
We've been neutral small caps waiting for a nice cyclical play, but we need interest rates to be lower. We need much less policy uncertainty, and we need stronger growth than what we're seeing right now in the first quarter. So we'll hold on to that neutral for a little bit and wait for a better opportunity. We think the money is placed better. It will have a better outcome for investors in large and mids.
Paul, Always great to talk to you. Paul Christopher, Managing Director.
Thank you very much.
Absolutely. And Head of Global Market Strategy at the Wells Fargo Investment Institute. Counting us down to those closing bells. 2.5 minutes to go, Alex Steele. The gains holding here on this day. A nice setup here for tomorrow. But of course, a lot of economic data bodes for this market.
Well, also, and then the continued headline risk. Although I have to say, when President Trump was talking earlier and talking about auto tariffs are coming, for example, market just totally took that in stride. Maybe the dollar moved, but equities just were like, okay, and kept going higher.
Yeah, I think it seemed maybe they're kind of trying to parse the tone, and maybe the tone is a little bit different and a little less scattershot than before. But as you said, who the heck knows? We'll try to answer some of those questions as a global simulcast to break down all of today's action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to that closing bell with the global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenovic in the radio booth as we welcome our audience across all of our Bloomberg platforms here on a relatively positive Monday afternoon, at least for U.S.
positive because
equities.
you're back, Romaine. Welcome back.
Thank you, Tim.
He brought the.
I was in your neck of the woods, Tim, out there in California.
I was out there too. Why didn't we hang out?
What?
I was out there the whole week.
Oh, okay. Well, there we go.
You were in Northern
you
California
see how close we are.
too, weren't you?
I was. I probably drove past the Stenovic household.
This is a little messed up because I was also out there.
Okay.
We were like ships passing.
All right, we need to talk after the show.
Okay.
Yeah.
Carol, I have no idea where you were.
You guys got to get your people to talk to each other so that you guys go out for a drink or something. I'm here and.
I know. You know how much you could have saved on a hotel if I just could have crashed at Tim's house?
Yeah, you probably would have called and just got his voicemail. I'm just going to say. No. Hey, what an interesting day. Futures were higher. We saw the market open higher. We saw momentum build, and we saw some buying into the close. So a positive day. We'll see whether or not it holds into the rest of the week.
Yeah, I mean, everyone's buying everything today. Bitcoin's even higher by 4%. You got Ethereum higher by 5%. XRP up 2.8%. It's not just equities. We're also seeing buying in crypto.
And everyone's looking past the manufacturing data that showed manufacturing contraction, also an increase in materials costs, which points to stagflation, kind of echoing what the Fed had indicated in its latest economic projections. But it's a worry for another day, I guess.
Yeah, and I'll just say it again. Looking at the Russell 2000, for example, the best day since November 6th. That ain't nothing from the day of the last election.
Yeah, and there are going to be a lot of superlatives here as we get the closing bell. You were pointing out early the Mag 7 as a group having their best day since, I believe, January. Discretionary stocks, consumer discretionary stocks, best day since 2022, believe it or not. Wow. That's a big part of the reason why you're seeing the S&P up almost 100 points or about 1.8% here on the day. The Dow Jones Industrial Average up more than almost 600 points or about 1.4% here on the day, while the NASDAQ Composite is going to close out the day up about 2.3%. And the Russell 2000 getting in on the party and, more importantly, leading the party, a melon party, up 2.5%.
Yeah, that's pretty significant. S&P 500, guys, most names in the S&P 500 higher today. Scarlett, 424 to the upside, 78 losing ground today.
All right, let's show you the IMAP because it's pretty a pretty basic IMAP here. All green, with the exception of utilities, little changed on the day. And as Romaine mentioned, consumer discretionary really in the driver's seat, up 4% as a group led by those auto companies. Communication services also gaining about 2%. And industrials in third place, up 1.9%.
It's not just auto companies, it's Deckers. Don't they make those like ugly shoes you like?
The Uggs, yes, they do.
Yeah.
Wow, harsh shade.
That's okay. He already shames me on the Birkenstocks, so this just goes with the territory.
If you have bad feet, you need the Birks, all right?
I think Romaine wears Birkenstocks with socks on the weekend.
100% does not.
Oh, come on. All right, let's get to some of the individual gainers, guys. Tesla finishing just off its best levels of the session, but still up about 12% here in today's trade. Number one gainer in both the S&P 500 and the NASDAQ 100, and leading really gains among the Magnificent Seven, as we talked about that whole group higher in today's session. I think just a sign that the risk on trade, is back on, but we've seen Tesla up several days in a row. So some upward momentum certainly in that one continuing. FedEx, also a gainer in today's session, up about 5%. Reported earnings last week. Stock dropped when it reported earnings and cut its outlook again amid economic worries. Well, the economic bellwether actually rallying today. Jefferies turned bullish, confident in the company's ability to continue to grow earnings regardless of top line underlying trends as it executes on its cost-cutting plan. So investors liking that news and moving into that one. United Airlines up pretty much at its best levels of the session, up more than 7%, was a top gainer too in the S&P 500. United will begin charging customers more to access its airport lounges to help combat a rise in overcrowding since the pandemic. We're going to talk a little bit more about this when we get into some of the stories on our radar, but we'll get into exactly what they're going to charge for that. But nonetheless, this was a big-time outperformer today.
There was some good gainers today, Carol.
Yeah, thank you very much.
Sure thing.
Occasionally I get it right.
Hard to find decliners today. I actually had to go abroad to find some decliners because the U.S. market was so strong today. I do want to start with Supermicro Computer in the S&P 500. Shares did fall after Goldman Sachs cut their recommendation on the company to sell from neutral. As of the last close, though, the stock is up 38% so far this year, falling today by about 1%. And then Novo Nordisk, ADRs of Novo Nordisk here in the U.S. fell by 2%. It has been unseated as Europe's most valuable public company. Now, SAP, the German software developer, is on top. Novo lost the top spot in Europe after its shares roughly halved since reaching a record high. That was back in June of last year. The stock got another blow today after Intron health analysts downgraded their recommendation to sell from buy. And finally, to Brazil we go, where we find Embraer. ERJ US are the ADRs here, down 6% today. Wolf Research out with a note cutting its recommendation on the company to peer perform from outperform. Once again, shares down by about 6% today.
Do you have any Asian stocks on there?
No, not today.
Okay.
Maybe tomorrow.
All right.
Maybe next time.
You covered like 3 continents. So that's
I know.
People are buying overseas.
It was kind of grim for decliners here, guys. You know this.
All right, talk about decliners. Let's go to the bond market. It was selling pretty severe, pretty much all across the curve. Whether you look at the 2-year, 8 basis points, or the 10-year, also 8 basis points. And we have $69 billion worth of 2-year coming on tomorrow. And we have the economic data. Ira Jersey, Bloomberg Intelligence, says he thinks the takedown is going to be pretty good for the 2-year. And we get 5 and 7s later on today as well. He said you'd have to double the yield for you to lose money in the 2-year if you bought it right now.
Yeah, wow.
That's a lot.
I'm sorry, though. Can we just go back to something that Carol was talking about? Because she was talking about United Airlines, the stock rallying on these lounges things. You might be in trouble. But here's the thing. So you're saying, so United has finally recognized what we've all known for years now, which is these things are way too crowded, these airport lounges. So now they're going to raise the standards to get in there, right? The price or the miles that you need to get in there. And is that, in theory, that's going to drop the number of people?
Supposedly.
Or limit the number of people?
Amex
but they're only raising it from like $650 to $750, so it's like basically a $100 difference.
Yeah, I don't know.
Do you use lounges, Carol Masser? You probably like to sit out.
I think I've traveled with you and seen you in a lounge.
Yes, actually, yeah, that is true.
Holding court in the lounge. I think I've seen you doing that.
That is true.
Well, I think Amex maybe last year or the year before changed their policy with the Platinum card because too many people were getting in. So now you have to spend, I don't know, like a lot of money, $70,000 or $80,000 a year on one of the cards in order to get guest passes for free.
Yeah.
But yeah, I mean, these things, like everything else in life, is getting more and more crowded. And there's a willingness to pay for people. So we'll see if it actually makes a difference. But I think that it could be tough to decrease the crowd.
But, increasing the fees from 650 to 750 is just 100 more, but it keeps some of the riffraff out. And it's the starting phase of increasing more, right? Oh, my God. I can't believe I high-fived him on that. But no, the idea being that, once you start raising prices, you kind of set the precedent for doing it again and again and again. At some point, it'll get to the level of folks that Remain is comfortable with.
Wow. You guys.
When will that be?
All I have to say is I spent a lot of money on my Amex and my husband gets the perks because there's some weird sexist thing that it's like under his name and not mine and it's very upsetting. So he can get to the Delta Lounge and I can't. But I do all the work.
Wow.
Yeah. Harsh words.
Drama in the Steele household.
Yes.
Wow.
Riffraff there.
Okay. All right. Well, if anybody needs a laugh, we're going to move on to this. Great story. And I have to really credit Tim because he's like, you got to check this out. Do this as a gainer because initially this stock was really high in the pre-market. I think up like 16%. It was up more than 2% in today's session, I think finishing the day little change. We're talking about Primo Brands. And they are home to Saratoga Spring Water. And an influencer by the name of Ashton Hall has put out a video, and I can't believe we're not going to show it because it's really.
Have you seen? You guys have all seen this, right?
funny.
In the memes over the weekend.
Wait, this is the blue water bottle,
Yeah,
right?
so-
The blue
Yes.
glass water bottle.
Yes.
So can I just say I saw this
Okay.
while I was on vacation. I had no idea what the whole point was, but I saw it just took over everywhere. I mean, I was more
But you've
focused
created
on.
your own
I was more
version
focused
of
on the
it,
fact
right?
that this guy apparently
He's trying to get into the
he looks
lounge.
he looks way better than me on my body. So I was like, so I can drink this water and look like him.
670 million views as
Yeah.
of this morning.
Yeah.
Okay, these videos. It shows sort of his routine, and the routine involves a very strategically placed bottle of Saratoga mineral water. And apparently, investors, at least earlier in the session today, thought, okay, maybe this would lead to some sort of sale. A lot of memes over the weekend of people going out and buying bananas, filling up
I
buckets
saw
of
that.
ice.
I'm sorry, I just have a question.
Yeah.
Was what he did, the original video, was that supposed to be a joke or was he serious?
That's a question for
Because
him.
if he was serious, I have some concerns.
It looked pretty serious to me. Let's just say.
Because he's like dipping his face in cold water. He's putting on a little thing on his
Hey,
nose.
but those are for your pores.
You rubbed the
That's
banana
important.
peel all over your face. Did you see that part?
I did see that.
Okay, good.
I assume this guy has no wife and kids or any sort of responsibilities other than just taking care of his
There was a
body.
woman's hand that came in at one point and put a bottle down, I think.
I
of
did see
Saratoga
that.
Springs, so.
His assistant.
A little piece.
I'm still watching it, guys, so I'll get back to
Yeah.
you.
Okay.
Oh, here's the banana. Okay, I get it now.
No, don't fall for that banana in the tailpipe.
All right, on that note, we're going to move along. All right, that's a wrap. Our
We've gone off the
cross-platform-
rails. Remember we used to always go off the rails here on Beyond the Bell or whatever we're calling this?
We used to. We
yeah.
used to.
Nowadays.
I don't know, closing
I don't know.
bell,
You're bringing us down,
whatever.
Carol.
Yeah, I know. All right, that's a wrap. Our cross-platform coverage of the close on radio, TV, YouTube, Bloomberg Originals. Folks, good to have Romaine back. We will see you again, same time, same place tomorrow. I know Alex is going to head out. She's going to continue watching that TikTok video. Scarlett and Romaine continue on TV.
And when we come back, the show does continue with the discussion on how technology is rapidly affecting the globe's institutional markets. A conversation after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day on Wall Street. We've talked a lot about these rebound rallies that kind of start strong and then fade. That did not happen today. We had one of the biggest gap ups at the open in at least 1.5 years. And you know what? That open was the low of the day, the high of the day, pretty much what you're looking at right now, up about 1.8% on the S&P 500, more than 2% on the Russell 2000, which was actually your outperformer as far as the big indexes go. The Philadelphia Semiconductor Index also getting a nice rebound. And then keep an eye on what's going on in other parts of the market as well. You had a little bit of a pop in oil today and a little bit of a pop in copper. Of course, both of that tied to a lot of questions and I guess to some degree concerns here about tariffs and other Washington policies. But for now, I guess maybe we can revel in the fact that we got a little bit of green on the screen.
Yeah, led by technology, although there was one tech name and very few precious tech names declining that I want to focus on here. SMCI Super Microcomputer down 1% on the day after Goldman cut its recommendation on the stock to a sell from neutral, saying this downgrade reflects AI server competition as well as margin pressures. AZEK, meantime, jumping 17%. It did climb as much as 21%. This is the maker of outdoor home decks and pergolas. It's being acquired by Australia's James Hardie for $8.75 billion in cash and stock. And you're seeing that give a lift to other makers of home building materials like Knife River as well as Vulcan Materials. A lot of green in that sector right now. And that brings me to our top story this hour, which is about how the outlook for U.S. housing at a time when stagflation and recession fears are rising. And I mentioned the James Hardie AZEK purchase. We actually saw James Hardie shares plunge in Sydney, in part because this deal reflects a bet on the U.S. consumer spending to renovate and upgrade their homes in the face of a very uncertain economy and increased costs tied to higher tariffs. Now, we get a read on demand for starter homes with KB Home's latest results, as well as a snapshot on home price and home sales trends later on this week. Romain?
Well, as far as KB Home goes, Scarlett, unfortunately, is not looking good. Those results just crossing the wire right now. EPS in the most recent quarter, a miss, $1.49. The street was looking for $1.58. Revenue in the quarter, $1.39 billion. That's a miss. The street was looking for $1.5 billion. Deliveries in the quarter, 2,770. That's a miss, below what the street was looking for at 2,996. You see the market reaction there on your screen. Another headline also involving the company naming a new CEO, Robert Diller, going to take over as CFO of that company. We're going to dive a little bit deeper into that in just 1 second. There's a housing.
Let me take over. You need to get a drink of water. We're going to take over on that in just a moment because the housing market, Romain, is just one point of uncertainty tied to the U.S. economy. And with that word uncertainty absolutely affecting the markets right now. Sonali Theisen is global head of FIC, e-trading and market structure at Bank of America. And she agrees, Romain. She says we are in a choppier, less correlated market given some of the unknowns in this current environment.
Yeah, so great to have you. I am curious. So you talk about this idea of sort of whether the market is healthy and whether the prices that we've seen, particularly over the last few weeks, whether that's a true reflection of price discovery. Does it seem like a healthy market to you?
Well, thanks again for having me back. It's wonderful to be here. And actually to be here at the closing bell for equities, it's really interesting because the Treasury markets now, the high watermark of volumes are really coalescing around that 4 p.m. as well. And if you look at the U.S. Treasury market, we actually think, despite, as you say, the choppiness, the uncertainty, it's functioning quite well. Just this month in March, we've had 9 days over 1 trillion of average daily trading volume. That's pretty massive, and that number just continues to grow. So I think it's in no small part due to the fact that the resiliency of the ecosystem has gotten better and better. 60% in volumes is now electronic. The turnover in the market, if you look at relative to the roughly 29 trillion of debt outstanding, the market's turning over anywhere from 3 to 4%. That number's actually been accelerating recently. So I actually think that, we're doing quite well, all things considered.
When you look at, though, that turnover and the volatility, and we've joked a lot on this show about how, the bond market, which isn't really supposed to be as volatile as the stock market, how that's kind of outstripped recently. Is a sense, though, that the bond market might have things more right than the equity market. I know bond investors always think they're smarter than stock investors, but this does seem to be one of the times where you get a better read on market conditions based on the price action in the bond market than in stocks.
I would certainly say that the bond market is behaving in a healthy, more organized way, right? Again, looking at the U.S. Treasury market adjacently, the repo markets are functioning quite well. And also going back to what we were just saying, again, that resiliency of being able to trade and express views very quickly is happening. The repo market, for example, just a few years ago was 0% electronic. Now it's almost 75%. And also, if you look at U.S. Treasury futures, that market is now trading in average daily trading volumes almost the same amount or even more at times than in the U.S. Treasury market. All of these are very connected, and I think that's part of what's driving the efficiencies in the bond markets and in fixed income markets.
We've seen a lot of volatility in the fixed income market over the past month or so. Have you seen anything disorderly, any kind of forced selling anywhere, especially right around mid-February, mid-March?
No, I don't think that again, the markets have gone up, they've gone down. I think that the way that the ticket sizes that are going through, the average duration that's going through in ticket sizes, there's certainly choppiness, as we talked about. Yeah. But, the market is digesting what's happening pretty well.
Okay, so things are going through fairly smoothly, no major hiccups or anything. In terms of products that people are using, you mentioned Treasury futures. There's this big growth of explosion in fixed income ETFs and active fixed income ETFs. I'm wondering how much of that is split between, say, futures or ETF products when it comes to trading these treasuries that you're seeing?
Yeah, that's a great question. So, not to state the obvious, but the market cares a lot more about the cost of capital, the cost of collateral when rates are at 4.5% than when they are at 0. So the growth in U.S. Treasury futures, the focus on cross-margin optimization, the focus on U.S. Treasury volumes going through, again, that whole ecosystem, repo, all working well is what the market has been really focused on. Fixed income ETFs are a massive part of the toolkit. Factor-based trading has come. It's live in fixed income markets now. So all of these levers are being able to be pulled, and that technology underpinning the entire ecosystem, I think, is what's helping us really create some stability.
I'm glad you brought up technology, because obviously we've talked really just everything every day is about AI, but usually in the capacity of more consumer-facing AI, or even what software companies are doing. Are you seeing more integration of AI on Wall Street in trading and other sort of market structure activities?
Yes, I think so. As we roll out AI tools to our global markets teams, I think what we're really seeing is increasing the scale, increasing the efficiency of how we're able to scour through the vast amounts of data, the natural language that comes into us, right? So we're really trying to get to a point where we can create almost a virtual assistant that sits next to our traders, our sales force, and really helps them look through all of the information that we're gathering day over day. Ultimately, we want to get to the point where we're actually just kind of wading through the data and information each day and saying, hey, what's the anomaly here? What's the outlier? So that's what we're building towards and working hard.
And I asked that too, and I just want to point out to our viewers, we did get a headline just a few minutes ago about eToro. Of course, the fintech platform. They are actually filing for a U.S. IPO, filing with the SEC, just crossing the wire. And I am curious about the expansion of what we call Wall Street, but of course it's not Wall Street anymore. But just kind of the expansion of that broader financial universe to include alternatives, if you will, and alternatives that are much more tech-focused, tech-forward, if you will, than maybe some of the traditional players.
I think that's absolutely right. That's absolutely happening. Technology is embedded in everything that we do. We're leveraging technology partnerships and, building a lot more tools in-house. So I think that's absolutely right. This is how we achieve scale in a controlled way. That doesn't mean that we're using Gen AI to come up with pricing, anything like that in the immediate future, but we use it to create scale.
All right, good stuff. Sonali Theisen is Global Head of FIC, E-Trading, and Strategic Investments over at Bank of America. Thank you so much.
Thank you.
All right, well, as we talk about the shifts that we're seeing as institutional markets adapt to new technology and new times, there's a big shift in sentiment, at least, out of Fidelity and Schwab today. The two firms blocking purchases of 3 ETFs on their trading platforms. The BlackRock and Texas Capital funds are the first to track money market securities in an ETF structure. Bloomberg's Emily Graffeo wrote the story, and she joins us now from Exchange, which is an ETF experience happening right now in Las Vegas. Emily, thanks for talking to us here, especially as you're attending this conference. This is kind of unusual for Fidelity and Schwab to prohibit clients from being able to buy these money market ETFs. That's typically what they don't do. They want to make every product as accessible as possible. What's going on?
That's right, Scarlett. So typically with exchange traded funds, if you're a retail investor, if you're a financial advisor, if you go on Fidelity and Schwab or these other large trading platforms, if something trades on an exchange like a stock, you should just be able to buy it. And typically that's what we see. You can buy it. That's one reason why ETFs have been known to democratize investing. There's less barriers to entry, this being one of them. We noticed in our reporting that if you go and on either Fidelity or Schwab and try and buy one of these, you're blocked from the trading. You get a notification that says, this security is not tradable. What the firm said, what both Fidelity and Schwab essentially said was they're just applying the standards of how they track money market mutual funds onto ETFs. So if you go onto Schwab, if you're trying to buy a money market fund, you can really only buy a Schwab money market mutual fund. Same thing with Fidelity. ETFs were almost like a backdoor to that, and now they are, blocking access to those ETFs. But that's right, that we don't typically see anything that trades on an exchange locked at Fidelity and Schwab.
Is this the kind of thing that people are going to notice? And I don't mean like, the nerds like us who have to cover this every day, but, are just sort of rank and file people with retirement plans and the folks that manage them for that matter going to notice this?
I mean, I spoke to 2 financial advisors who were clients of Texas Capital's money market ETF. They had bought that fund. They wanted the ease of trading of an ETF, and they also wanted money market fund exposure. So when this fund launched a couple months ago, they were excited. They shifted client assets in. And then when they were told by Schwab that they could no longer invest in it, they both said, it's not the end of the world. I'll just shift back into maybe some short-term treasury bill ETF. But this is operationally a little bit of a headache and something that they weren't expecting. You typically think that if it's an ETF, you can buy it anywhere. Now, the question now is, will this expand to other products? We're not sure. At least Schwab and Fidelity right now don't seem to have any plans to apply this to other ETFs. It does seem confined to the money market ETF world.
All right, Emily Graffeo out there in Las Vegas. A great story on the Bloomberg terminal here about a very conspicuous absence here on the Fidelity and Schwab platforms when it comes to money market ETFs. And I know you were talking, you actually host a show on ETFs.
We do, yes.
And anyway, I heard you talking about it a little bit earlier. I'm told in my ear we have to go.
Yeah, our producer's rushing us right now.
We got to go. Top 3 coming up next. Stick with us. This is Bloomberg.
It's time now for the top 3, where we name drop some of the people driving the day's most talked about stories. And first up is Anne Wojcicki. She resigned as CEO of 23andMe after the genetic testing company that she co-founded filed for bankruptcy protection.
Yeah, this has been a long running saga. I don't know if this is the end of it. I mean, anytime lawyers are involved, it never quickly ends. But this does seem like it's finally coming to an end. And it's kind of, I don't know. I mean, not that I had any stake in this in the survival, but I always thought this was kind of an innovative idea when it first started. I know it didn't quite live up to its promise, and I know she wants to kind of reclaim it so she can maybe get it there, but definitely looks like this might be the end of it.
The problem is there are no repeat customers. Once you get it once, you're kind of done, right?
That's a good point here. Someone I'm keeping an eye on is Ken Griffin, and a cadre of other billionaires and chief executives were out in China, and they had a chance to meet with China's vice premier. And it was kind of interesting because Beijing basically had a message for him, for some of the other folks there, like the CEOs of Pfizer and was Apple, Tim Cook. The idea that Beijing wants U.S. money. They want U.S. investments. Whatever sort of is going on between the administrations themselves at the government level, they're basically saying, look, at the business level, we're still here. We're still open for you. Come back in. Griffin seemed to be receptive to that message, at least based on the reporting that we have out there.
Yeah, and of course, Citadel Securities did hand in its application to set up its own China brokerage as well. So the timing couldn't be better, at least for Ken Griffin. All right, the final person we're watching is Reed Hastings. The co-founder of Netflix is donating $50 million to his alma mater, Bowdoin College, to create an AI program. It's not going to develop AI, this program, but they're going to use it as a step forward to provide an ethical framework for technology.
I thought that was an interesting component of it. We'll see how that works. It's also kind of interesting, too. He's been giving away a lot of money as of the last few years.
He's legacy building.
Yeah, I know, since he stepped away from his role at Netflix, maybe potentially something good. All right, we'll be back in a moment, a deeper dive into the state of the housing market with Daryl Fairweather at Redfin.
All right, welcome back. We're looking at shares of KB Home down more than 8% after the home builder cut its full-year revenue forecast. And of course, there's more housing data on the way this week as we look ahead to new home sales and home price data. Both of those are out tomorrow. Joining us now to discuss the state of the housing market is Daryl Fairweather. She is chief economist over at Redfin. And Daryl, what's interesting with KB Home is that we know a lot of people want to buy homes. There's a lot of demand out there, just not at these price levels. And it's something that the CEO has referred to in his statement, saying that consumers are working through affordability concerns. No one can get an affordable home. That seems to be the main issue.
Yes, that is what we're hearing from our buyers as well. At these high interest rates and high prices, it's very difficult to make it work. It's hard to not go over the rule of thumb of spending more than 30% of your income on housing, and that puts people in a precarious situation. And when there's all this economic uncertainty, people aren't willing to take that risk.
And when it comes to home builders trying to move inventory, they've been buying down mortgage rates quite a bit, but that will cost them. Is there any indication that they can get to a point where they no longer need to do that to move some product?
I think that for now, if they want to move product, they will either have to cut prices or add in enticing things like a mortgage rate buy down. There aren't that many buyers right now that are willing to spend big money on new construction, and new construction costs more than existing homes. So you're already starting at that higher price point.
Well, I mean, where are we though now, Daryl? I mean, we're basically kind of in what is traditionally going to be a relatively strong season for home buying, at least what traditionally would be. I know we haven't had that the last few years because of some of these disruptions. There was a lot of talk that this year was going to be kind of more of a resumption of that long-term trend. Is that not going to happen?
That was my hope, that this year we would see an increase in home sales, but so far the activity has been really stale. We're seeing a bit more demand right now. I'm holding out hope that it is just a delayed start to spring instead of no spring season at all. But these high rates are scaring off buyers. And the rental market is looking better. If you're comparing apples to apples, you're probably going to be saving money in the short term if you're renting.
I'm also curious, too, about just the generational differences and how that's affecting the housing market. There's been a lot of hay made about the younger generation, basically, the Gen Zs and maybe the really, really younger millennials not really being in a position to buy a house in the same way that maybe Gen Xers and certainly baby boomers were at a similar age.
Yes, Gen Z and millennials, they are losing ground when it comes to homeownership, or at least they're not progressing the way that previous generations have. There was this window during the pandemic when mortgage rates were really low and anybody who had the ability to buy a home went out and bought one. We saw people buying second homes even. And that gave some young people the opportunity to buy homes earlier than they would have otherwise. But starting in 2023, interest rates went up and that door closed shut and left many millennials and Gers on the other side of it. And now they don't know how to break into homeownership anymore.
So there's, of course, different kinds of housing stock out there. There's new construction, which is what KB Home does, albeit at the starter level. And then there's existing homes. And I wonder, in places like Texas and Florida, where they've seen a lot of demand because people were moving there after the pandemic, what does the supply picture look like for new construction versus existing homes when a lot of people are starting to put their homes on the market?
In Florida and Texas, there has been more new construction than in other parts of the country. It's easier to build there. And what's happened is that has increased the number of vacant units available when it comes to buying a home or when it comes to renting one. And so that has kept affordability a bit better this year for those states. Compared to the Midwest, where prices have gone up quite dramatically. And Milwaukee prices are up like 20% this year alone. So if you build, it does help keep prices in check. I mean, if you're a homeowner, maybe you're not so happy that you're competing against all these new homes if you're selling, because you might not be able to get as much for your home, or your home might take longer to sell. But it's good for buyers when there's more options available.
What about greater Los Angeles? I mean, obviously, that's its own market and has its own issues because of the wildfires, but there's a lot of demand, clearly, and we've seen the supply part of the equation get disrupted by the fires. There's a lot of rebuild. What does that look like, and what kind of opportunities are there in that region?
Well, home sales were disrupted in the affected zip codes following the fires, which is what you would expect. I mean, life has just kind of shut down for a lot of people in those neighborhoods. There will probably be more listings in the future, though, especially as people start to figure out where they stand with their homes. And I think people may decide to sell, even if maybe they were hoping they can move back in. They're realizing it's going to be too much work, or there's going to be too much nuisance noise from other people building. So I think over the coming months, there will be more lots for sale, or even homes that weren't really all that damaged for sale as people try to, start over in different neighborhoods. But some people will hold on and wait out for everything to get somewhat back to normal.
So let's tie all this together, Daryl. And I am just curious about how everything kind of interplays with each other, because we've also talked a lot on this show about rent prices going up, particularly in areas like in the East Coast, Northeast, where we are today. And how much does the health of the home sale market affect those rental prices?
Well, when people aren't buying homes, generally they're having to rent. And there's probably going to be more demand for apartments this year. But there are more vacant units available because of all the building that has happened since the pandemic. We're still on the tail end of the construction boom in multifamily homes. So if you're in an area where there has been a lot of construction, you can probably get a better deal on rent this year. And that gives you another reason to postpone buying a home. But I think that's good overall for renters, that their rents are going to be stable. And at least that's one less thing they have to worry about, getting a rental increase.
All right, Daryl Fairweather, thank you so much. Chief economist over at Redfin, giving us a snapshot on the state of the housing market, which remain, as we discussed, is pretty localized to where you're looking at, whether it's Florida or in Texas that has a lot of supply, or LA.
Yeah, and we talk about, too, because there's been a lot of talk about how difficult the housing market is and how that interplays with the stocks. But of course, with the home builders, it's much more of a long-term play, right?
Yeah.
I mean, you're not really buying those stocks for the money or the bill or what they're building today. It's about 5-10 years down the road.
Yeah, but they're in a tough situation because they need to make those homes affordable. And it's hard to do that with rates where
Don't
they
we
are.
have a housing shortage, though? So you would think that, you would see more activity and in theory, obviously maybe play more to that affordability. I know that doesn't always sort of shake out. Then, of course, you have to throw in policy uncertainty in Washington,
yes.
how that's going to affect goods maybe coming in and out of the country that you need to build those homes, labor, for that matter.
Not to mention state and local taxes in some of those high tax states as well.
Yeah.
So a lot to consider here. All right, in terms of what happened in the markets, pretty easy to consider here because a big gain here to start the week. Risk on all the way, whether it's bidding for equities, selling treasuries. You can see the 10-year yield spiking up by 8 basis points. The S&P 500 adding 1.75%, and really chip makers powering things up 3% as a group.
I just want to point out the S&P 500 consumer discretionary sector. That was the big gainer on the day. Best day going back to 2022.
Remarkable.
And obviously, Tesla is a big weighting in that. But, it's 47 of those members were still in the green on the day. Only 4 were down. And you had names like Deckers, Ralph Lauren, Royal Caribbean, Ross Stores, Ulta, all up 4, 5, 6%. So if we're concerned about consumer spending, we're concerned about inflation, shouldn't those names be down? I mean, maybe there is hope here that this is about expectations rather than the reality of what consumers are actually doing right now.
It's a bit of a relief rally after some pretty big takedowns in the last few weeks, but it's a big question mark as to where we go from here. It all depends on tariffs and sentiment.
Yeah, Starbucks, though, was in the red.
All right.
So was Nike.
Well, Starbucks in turnaround mode, and so is Nike. So you have some idiosyncratic stories to go along with those.
What about Yum Brands? I thought everybody loved Yum. That's like Taco Bell, right?
If you're into Taco Bell, I know you eat at fine dining. This is the close on Bloomberg.
President Donald Trump today threatened a 25% tariff on any country buying oil and gas from Venezuela. He's aiming, apparently, to cut a major source of revenue for the Maduro regime, a tariff that would go into effect on April 2nd, Liberation Day, the same day his administration is expected to unveil a broader array of tariffs. Bloomberg Balance of Power co-host Kailey Leinz joins us right now to talk a little bit more about this. All right, we're going to get to Liberation Day in a second, but I am curious about this move on Venezuela because I've been a little confused as exactly what this administration's relationship is with the Maduro regime. This seems to suggest maybe it's not that great.
Yeah, this is the administration wanting to pressure the regime in Caracas, Romaine, for what they alleged, without evidence necessarily, is Venezuela purposefully sending criminals and gang members like Tren de Aragua to the U.S., many of which, of course, the Trump administration is actively or has already tried to deport, which has faced legal challenges. But this really is about behavioral changes it would like to see on the part of Venezuela and what it views as bad behavior, doing so not just by potentially hitting revenue, but hitting other countries that import Venezuelan oil and gas. I would note here that the United States is a big one of those, that there's no mention as to how exactly this is going to impact U.S. imports of Venezuelan oil, but other countries like China are big buyers. India, Brazil could be categorized in this way as well. And when asked by reporters at the White House today, President Trump said that the 25% tariffs he's threatening to go into effect next week would be on top of existing tariffs. So for a country like China, which already is facing in this administration a 20% tariff on all of its imports into the United States, that could bring the number up to 45. And that's just the beginning of what we are expecting on April 2nd. He once again said reciprocal tariffs will be going into place on that date, which is next week, though he did clarify that he does expect that he may be making exemptions for certain countries. So that's obviously something the market took well today.
Yeah, they took well, and they helped send the stock market to big gains, risk on overall. But let's stay on that idea of maybe some carve-outs for these April 2nd reciprocal tariffs. At this point, it just adds confusion into the mix, doesn't it?
It absolutely does. As previously he had suggested, there might not be exceptions to this reciprocal tariff date. Now, we know the administration is actively working with a number of governments on trade policies, including India. Administration officials will be traveling there this week as they work out a kind of bilateral trade agreement with India, particularly, which, like many emerging markets, has a higher tariff rate on U.S. imports than some other countries. So it's going to be unclear until we get to April 2nd what countries exactly could see exemptions and what the criteria criteria for those exemptions actually are. Something else we'll look for clarity on is whether or not there will be any sectoral tariffs that go into place on April 2nd, on Liberation Day. As President Trump at the White House today suggested that the 25% tariffs on auto imports he's long been threatening could come in the coming days. Just no telling if that means this week or next, if that's included on April 2nd or not.
Well, Liberation Day for the U.S., at least if you believe how Trump is characterizing it. But does that also become Retaliation Day? I know technically these are supposed to be our retaliation against their tariffs, but we've seen how this works out. Should we be preparing ourselves for a response from whatever countries or industries that he targets?
Certainly, Romaine, we have already seen that happen in multiple instances. The EU has retaliated against tariffs on steel and aluminum. Canada has tariffs in place on U.S. goods in retaliation for the tariffs that have been placed on that country. China has done the same, targeting things like U.S. LNG. So there could be plenty more retaliation to come from these countries, hence these negotiations that in some ways may be bilateral, depending on what the trading partner actually is. But what the administration has long argued is that any pain that could result from retaliatory tariffs is going to be short-term in turn for the long-term gain that they see as rebalancing U.S. trade relationships. This is something that the new chair of the White House Council of Economic Advisors, Stephen Moran, told our colleague Saleha Mohsin earlier that he doesn't actually think much pain will be created by these tariffs, and that is the argument the administration is sticking with.
Yeah, that's been their story all along. Kailey, I got to ask you one final question about this story that's really taken newsrooms by storm, at least here in New York, and I'm sure in Washington as well. The editor-in-chief of The Atlantic was apparently added to a text group where Pete Hegseth, the defense secretary, shared detailed plans on the U.S.'s bombing Houthi militants in Yemen. And for some reason, he was part of this, and he kind of was taken through the whole journey into the bombing. What's the White House's reaction to this?
Well, the National Security Council, through a spokesman, Scarlett, has confirmed that this chain, which was on Signal, the encrypted messaging app, does appear to be authentic, and that they are looking into how a number inadvertently got added. That number, of course, the inadvertent ad was Jeffrey Goldberg, the editor-in-chief of The Atlantic. And there's a few different components to this story. One being that Signal is not an authorized platform to discuss classified information, the kind of which, according to Goldberg's reporting, was shared by the defense secretary, Pete Hegseth, who gave specific details as to the planned military action against the Houthis in Yemen, as well as the kind of internal dialogue with some of the most senior national security and White House officials in this administration as to whether or not these strikes were even warranted or a good idea in the first place. The vice president, or at least someone who appeared to be J.D. Vance in this message, initially had expressed some caution around it. So there's the question of the information that was being distributed through this channel. Add in that a journalist was part of it. It raises many legal questions as to how classified information was actually being shared. And this is something that even some Republican members of Congress are now calling for an investigation into.
All right. Bloomberg's Kailey Leinz, thank you so much. And of course, you can check out Kailey and Joe Matthew at the top of the next hour for a balance of power. Let's stick with Washington right now and bring in Jeannette Lowe, who is managing director of policy research over at Strategas Securities. Jeannette, you heard us talking about tariffs and April 2nd, Liberation Day. As that is going on, we also know congressional Republicans are focusing on moving forward with a massive tax bill to deliver to President Trump. They've talked about this big, beautiful bill. Can you give us a state of play in terms of how far along they've gotten with putting this together? Because it's a pretty big ask at this point.
Yeah, absolutely. So there are two steps to reconciliation. You have to pass a budget resolution first, which the House has done, and then you can move on to the reconciliation package. But the budget resolution also still has to be passed by the Senate, and then it has to make sure that we have the same version going through both chambers of Congress. They haven't figured that out yet. So that is where they are still focusing on. So that is about what kind of cuts might be included in this bill, what kind of tax changes might be included in this bill, and then they'll actually get to writing it maybe in later April, and then they'll try to still aim to get this done by the summertime. But I think it's an important point because they are starting to have these conversations about which tax provisions can be included in this bill, and the tariff discussion comes into this quite a bit. So they may actually make some more pro-growth tax provisions to be included in that reconciliation bill, given depending on what kind of tariffs we are seeing that come out on April 2nd. When are they implemented? Are there delays? Are there these breaks that Trump said today about giving to other countries? And that'll be important for then how they ultimately do structure that tax bill. So I think Congress is also going to be watching the April 2nd announcements quite carefully as well.
Yeah, looking for the revenue being generated by those tariffs, but that is a moving target. In terms of timeline, where does that put us, practically speaking, that the Republicans in Congress, in the House, can get something together?
So again, I think they have a couple weeks here where they're going to try to figure out what to do on the budget resolution. They have a break in April for the holidays. So then I think that they're going to really start trying to work on writing this tax bill once they have that budget resolution done. Now, obviously, they're doing some of that work ahead of time because they have to kind of figure out which tax provisions will be included, and then they'll build out that bill as they move forward. But again, the summertime is really the deadline that they are looking to get this done. They still have a lot of things that they need to consider. And I think it's also important is that the bill, even if we do have tariffs going into place, that tax revenue doesn't get counted for the tax bill. So they still need spending cuts, even if there are tariff increases that you can point to say that you're offsetting the bill, but that may not be enough for some members.
All right, that's down the road here. But before we get to that, Jeannette, there is a big question here about the support in Congress for any of this. I mean, whether it's on the Republican side itself, and I know for the most part, the House Republicans have been relatively lockstep in line, not necessarily so in the Senate. And then, of course, you have a Democratic Party that, at least right now, seems to be having a lot of soul searching about what it wants to do, what it wants to be, and more importantly, who its leadership might look like.
Right. I mean, I think you can see, though, the fact that the House of Representatives, they have a very slim majority. They were able to pass the budget resolution with only one defection on their side. So a reconciliation bill means that Republicans are able to move this all on their own. They don't technically need Democratic votes to get it done. And that is what their intention is going to be moving forward. So obviously, I think that's important. They are on board with the Trump agenda at the moment. I think, obviously, tariffs are creating some concern. The fact that we're seeing that maybe some of this is being walked back, the fact that maybe sectoral tariffs on autos and pharmaceuticals may not come into play. Maybe they're announced on April 2nd. Maybe some of the other countries, you get a couple countries that are announced for reciprocal tariffs. Others have a delay, so there can be negotiations. I think that is important because there are members of Congress who are concerned about how much tariffs go into place, what impact does that have on the U.S. economy, and that's going to play into this. But right now, you do have the Republicans overall quite unified in the Trump agenda, and they are definitely going to be getting a tax bill done. It's just been down to the specifics of what will be included in that bill.
Is that agenda what the voters want?
Well, I mean, I think that's obviously something we have to see. I mean, the voters right now are not exactly enthralled with, I think, tariffs and having higher costs. But you have seen some polling, and you've seen the Republican Party has generally been supportive. Republican voters have been supportive of tariffs and, specific tariffs, even on Canada and Mexico. The majority of the party is there. So, I mean, obviously, we'll start to see if that changes once they actually go into place. Obviously, things are always a little bit different once there's actual implementation. But you do have economic concerns. You do have people who are less confident in the economy at this point. You've had Republican numbers within the consumer confidence survey go down over the past couple of weeks. So that is something I think that will be important. And obviously the administration and members of Congress will also be watching what voters are thinking about the economy with regard to tariffs and the tax bill as well.
All right, Jeannette Lowe, Managing Director of Policy Research over at Strategas Securities. When we come back after the break here, we're going to set you up for what the market's going to have their eyes on over the next 24 hours. Stick with us. This is The Close on Bloomberg. As we wrap up the day here, let's push ahead to Tuesday and what the markets will going to have their eyes on. There's going to be some earnings, not a whole lot. We start off with the consumer staple.
Yeah, McCormick, the spice company, will be reporting. We're really at the tail end of earnings season right now. Big questions about tariffs and what that means for the company overall. Yeah, in addition to that, though, we are going to get some interesting economic data tomorrow as well, including new home sales as well as that house price index. We were just talking with Daryl Fairweather there. Doesn't look like we're getting any relief on either one of those metrics. Absolutely. And of course, KB Home just cut its full year revenue revenue forecast as well. So that speaks to some of the struggles in the housing sector, especially when it comes to questions of affordability.
Yeah, and I just also want to point out consumer confidence, too. That's going to be a big number. This is the Conference Board's numbers. And remember, the last number we got was awful. I mean, it was basically the third straight decline. I was taking a look at the Bloomberg estimates. The estimate that they have for this fourth straight month of declines, it's going to be one of the biggest drops that we've seen, or the lowest levels that we've seen since the pandemic, like 2021.
So you wonder if that's going to cause another leg down in the market, or whether that's kind of priced in right now.
Yeah, absolutely. Then we have geopolitics to worry about as well.
Yeah, the U.S. and Russia host talks in Saudi Arabia. We'll see how that goes. And then after the market, there is still a little bit more earnings.
Well, maybe not earnings, but there will be a report. And this is actually from GameStop. Who knows what they're going to say, but of course, we'll have all of that coverage for you right here on Bloomberg.